you can pick winning stocks. Wall Street wants people to think you need to pay someone else a huge fee to do it, but you have better skills than you realize and many advantages that Wall Street doesn't have. All we recommend is you save $2,000, which is just saving up $1,000 twice. In the 1950s, there was a firefighter from New England who noticed a company in his town constantly hiring and expanding. So he started to invest $2,000 a year towards this company. 20 years later, he retired a millionaire. The company was called Tampax. To invest in a great stock, you need to find a great company. Over the long term, the stock performance will be equal to how the business performs. Look at McDonald's. If you had put $2,000 into McDonald's at their IPO date, that would be worth over $8 million today, adjusted for splits and dividends, without investing another cent. There's other great companies out there too, and most of the time, they aren't hiding. Don't invest with the plan of holding the stock for a year or two. Sometimes the best investments don't pay off until the 5th, 6th, or even 7th year of owning it. Make sure you have the patience and discipline to put this money away and do not touch it for at least a decade. Stocks will go up and down. You don't want to be put in the situation where you have to sell when the market just dropped. Remember, the most important organ in your body to be a good investor is your stomach, not your brain. So here are 5 things to look at when trying to understand if this business is a good investment. The first is looking at sales and earnings growth. Is the company selling more products? Are they coming out with new products customers are demanding? Understand the story and what direction they are headed. If you can find a company that grows 25% a year, profits will double in 3 years, quadruple in 6, 8-fold in 9 years. That's how you get a huge stock return in a decade. The other great thing about growth stocks is you have plenty of time. You don't need to buy right away. Even if you bought Walmart 10 years after it went public, you'd have a return on your money of over 30 times. Secondly, what competitive advantages does the company have? You need to have a reason for buying a stock. You need to do some research here, talk to people. Find out if the company's products are any good. If you bought something, would you buy it again? If you went Black Friday shopping, what stores were customers flocking to? What stores were being avoided? Use your knowledge to your advantage. Great investments can be more art than science, but you have to understand where a company is positioned relative to competitors. Third, you want a company that generates good cash flow. Free cash flow is taking cash from the business minus cash used to invest in the business. So after your salespeople work hard to go and make the sale, and you reward them with incentives, pay for the flights, pay for the rest of your employees, pay just to keep the business alive, then you need to pay to grow the business and maintain your current cash flow generation. What cash remains is the company's free cash flow, and you want your sales to translate into free cash flow at a rate of 10% or more. That's a sign of a great business. While there are many great businesses, they don't all trade for a cheap or reasonable price. So the very next important piece is valuation. Let's say you have an ice cream shop. It costs you $100,000 to buy it, and it generates earnings of $10,000. Well, the price is $100,000 and the earnings is $10,000, so the P to E ratio would be 10. Is that cheap or expensive? It's hard to know because you need to look at the PE relative to the industry, relative to the expected growth, and relative to their own historical PE. For example, let's say while this ice cream shop is at a PE of 10, the one down the street trades at a PE of 5. Now you might say, whoa, I would definitely buy the one down the street because it has twice the earnings power, until I mentioned to you that this one is right next to a school and kids go there every day. And by the way, this school is growing rapidly and really increasing their student base. See how ratios must be put into perspective to have meaning? There are a ton of valuation metrics, and I plan to touch more on these in future videos. Just keep in mind if a stock trades at a low or a high PE, you need to understand why. Do a little digging. The fifth metric when analyzing a good business is a high return on capital. This measures the return an investment generates for capital contributors. Through buying stock, you are a capital contributor. You're giving the company's management your money to generate a return. So basically, you want to look at what kind of return management was able to generate with this capital. This usually implies a competitive advantage. Companies can continue to invest at a high rate of return. Look for over 15% as a general rule. Now, return on capital is generally used by growth-oriented investors. People at or near retirement will be more concerned with return of capital. Let's go back to the ice cream shop. If the shop did not want to use the capital given by investors to continue to grow the business, they could instead return this capital to the shareholders. For example, the company paid out this $10,000 in earnings as dividends to investors. Well, after 10 years, you pay off your investment and then generate $10,000 a year in dividend income. Not such a bad deal. So a quick recap. We want businesses with growing sales and earnings, competitive advantages, positive free cash flow as a percentage of sales of 10% or more, reasonable valuation metrics compared to the company's own history, peers, and considering expected growth. We also want companies with high return on invested capital or produce a solid return of capital if you're at or nearing retirement. The good news? We've already identified some great picks for you. So don't forget to subscribe so we can help you retire financially free.